First of all, I'd like to thank everybody for joining who's on the webinar today. Happy to have Chris on board with us to discuss the unveiling the impact of the regional bank crisis has on the commercial real estate space. First and foremost, I do want to, by way of brief introduction, my name is Ed Hagerty, Senior Director of Sales here at CompStak. I've been in the commercial real estate space for nearly 10 years, starting my road in CRE with RCA, which is now MSCI, and since have been leading the sales team here at CompStak, where we specialize in lease and sales transactions across the US. Chris Henkel, also from Henkel Analytics, President of Henkel Analytics, is joining me. Chris has nearly 30 years of banking, finance, and risk analytics experience. He began his financial services career as a commercial banker and credit and financial risk management expert for regional bank out of Texas. Before starting Henkel Analytics earlier this year, Chris served as managing director at Moody's Analytics, a New York-based leading provider of financial intelligence and analytics tools in the CRE space. Chris, how are you doing today?
Great. Happy to be here. Thanks, Ed.
Absolutely. So just to dive right in, some of the things we're going to be covering off today are the current landscape of the CRE real estate space, really talking about and leaning into the regional bank situation that's going on right now, really the implications of current trends on the availability of credit and lending standards, impact of interest rate hikes and loan maturity bubble that's coming up in the market, and then which sectors are thriving, which seem to be most heavily affected by the regional bank crisis, and then tying that into what lies ahead for CRE, best case and worst case scenarios for different sectors in the space. So just to get things kicked off, we're going to go right into this perfect storm that we're seeing in the CRE space, right? And many feel like it's a perfect storm out there, what with upcoming loan maturities, interest rate hikes, and now the regional bank collapse. It seems like things may head from bad to worse. As it relates to regional banks and CRE lending, there seems to be quite a bit of pessimism. A lot of estimates pin, regional banks holding about 80% of CRE loans. This strikes me as, false. Regional banks are still behind a sizable chunk, though, of CRE loans, something closer to 30 to 40%. I really want to turn it over to Chris to, discuss that in a little bit more detail. How much is this new CRE lending thread set to unravel commercial real estate, or is this just a lot of headline risk? Delve into the regional banks in particular, and who will step in to fill the gap that these banks leave behind.
Excellent, thanks. So I think if we just maybe frame, what do we think of a perfect storm and what's making headlines today? Really, a lot of what we want to cover over the next hour or so today is kind of related to that whole theme around commercial real estate, with that emphasis on the regional bank space. So Ed already talked about the outstanding CRE debt. We'll get into that in a minute, but I think a big takeaway is that a large share of the actual CRE loan originations and debt being held, CRE debt being held today, is within the banking community, and more specifically concentrated in that regional bank space. So we'll get into more of that. So that's kind of one factor in the concentration risk there we're going to talk a little bit about. The other one is, as a result of what's happening in the market, a little bit of confidence concerns, recessionary fears, rising interest rates, looming default risk. So there's a number of things that are starting to cause lenders, and not just banks, but like life insurance companies and others, who kind of sitting more on the sidelines. But we're seeing tightening lending standards. And so what does that then mean when you have a wave of renewals coming up and loan maturities coming up, especially loans that were underwritten at a rate much lower than what the prevailing rate is today? So what does that mean? And then you're hearing a lot with the recent failed banks about what the regional bank crisis means, and does that present contagion risk for the other regional banks, and what's the difference there? A key thing there is, I think there is a lot of headline news there, but if you start to really deconstruct what caused those earlier bank failures, it wasn't necessarily a commercial real estate issue. It was more of a rapid reduction in deposits, and most of which were uninsured deposits that as a result, had to have longer term, lower yielding assets being sold at significant discounts, and a lot of those being securities. And so when that happened, you basically had unrealized losses becoming realized losses, despite them being very well capitalized, create a lot of problems. But really, I think when you start thinking about the commercial real estate perspective, that really wasn't a lot of what's driving it. So I think when you start seeing this regional bank crisis, I think it's a lot more headlines than it is something that's more of a contagion risk. And we already talked about this is the concentration. We'll get more into that. Spend a lot of time focusing today, though, particularly on the office sector, because one, that is a component or a sector where we do see a larger share of loans coming due. We see a larger share of leases coming due. So what does that actually mean? And then you tie that into the credit risk issues, economic risk, economic issues, rising rates. And maybe the less availability of capital and financing. So like that's going to be a real pain point, something we want to spend a lot of time focusing on today. And as I mentioned, like I said, the issue around the recent failures wasn't necessarily a serious issue. We could have an entire session on each of these topics, but at least wanted to say, like, what does that mean in terms of perfect storm? So what we want to do next is really kind of delve into a little bit about the banking landscape and try to get a little bit of background on this. And then we'll delve into specific topics on each of these. So with that, Ed, let's go to the next slide. So first, just taking a little bit about the banking industry. So the total CRE debt outstanding is right around, I guess, estimated to be about $5.5 trillion. Different ways of measuring it. If you look at it across all the different service providers. And at the end of last year, banks were holding almost exactly half that, 2.8 trillion. And what's really interesting to look at on these slides, so the orange bar is reflecting over the last 23 years, 22 years, showing you what the total assets are held by all banks. So you can see at the year 2000, there was just under 10,000 banks holding less than 8 trillion in assets. Today, there's less than 5,000 banks holding 24 trillion in assets. And what's really noteworthy is what you see in those last two bars towards the end. So while the average annual growth rate in total assets has been roughly around 6%, certainly outpacing the number of banking employees and the number of banks, the one thing that's really interesting is that really sharp growth rate we saw during the pandemic. And by no coincidence, the amount of fiscal stimulus that the government put in during that same time period was also $5 trillion. So that really is helping to explain why we're seeing a lot more of the originations, a lot more of the outstanding debt being held by banks. And the growth rate of commercial real estate is even actually greater than the growth rate of total assets. So let's keep moving forward. So then if we think about those 4,700 banks, on the left-hand side, that's showing you the total distribution of banks by size. So you can see nearly 2/3 of the 4,700 banks are community banks between 100 million to 1 billion assets. And then you've got another 16%, so nearly getting us to about 80%. That are less than 100 million. So by count, 80% of all banks are less than $1 billion, so community banks. However, those 80% only represent about 5% of total banking assets. So if you look at the right-hand side, you can see where that less than 100 million is about 0.2%, and the 100 million to 1 billion is a little less than 5%. So you're looking at roughly about 5% there. Flip the other way, that the regional banks and large banks are holding the lion's share, 95% of total assets. And then if you really look at what we're seeing, which is today, the focus of today's session, is being represented in that yellow slice of the pie on the right-hand side, which is 30% for the mid-size and larger regional banks, and then in the gray slice for the larger community banks and smaller regional banks. And the reason we're focusing on those is because, as you'll see in a little while, that's the segment of the banking population that's holding that 2.8 trillion that has the greatest concentration in commercial real estate. And that's where it makes up a big source of the financing to the industry. So continuing on with this, we'll get into a little bit more of a breakdown. So the right-hand side is a depiction of the total 5.6 trillion outstanding in CRE debt. Again, as I mentioned earlier, about half that being held by banks. The table on the left-hand side is giving you that breakdown. So you can see in the far left column, you're looking at, if we include construction and development, which some of which is 1 to 4 family, but a lot of that also is commercial real estate. So you're looking at, of the 2.8 trillion outstanding, if you look at that bottom row, those two segments that we were talking about in the prior chart represents about 2 trillion. So said another way, half of all the CRE, half of the total CRE debt is being held by banks, and about 2 trillion of that 2.8 trillion is being held by banks is being held by regional banks. So again, that's kind of just re-emphasizing the point. While it's not certainly as big as that 80% number that is being thrown around in reference, it is very significant, especially when there's a lot more emphasis and reliance on new originations and upcoming renewals and maturities being falling on kind of the shoulders of the regional bank community. So continuing. So similar to the total asset chart we had a couple of slides ago, this is showing a breakdown of total commercial real estate. And as you can see, looking again at the right-hand side, you can see, which is depicted by the green annual growth rate, there's been a really sharp decline since since pre-pandemic in the total amount of banking loans outstanding. And so this is, again, now presents a little bit of a challenge that we'll get into talking about in terms of concentration risk. So if you think about the regulatory guidance and prudent standards on risk management, it's looking at what is your concentration of commercial real estate loans as a percentage of your total outstanding loans and as a percentage of total outstanding capital and reserves. And then also, what is the actual period over period or year over year change in that growth rate? So because we're seeing this rapid growth largely in that regional bank space, that's also starting to cause a lot more concern around CRE concentrations, especially at a time period when there is a lot of that uncertainty and potentially that perfect storm coming together. So against now we kind of look at the backdrop of what the banking landscape looks like and why we're spending so much time focusing on the regional bank segment. I want to give a little bit of a snapshot of kind of what the state that we're currently in and why this is a little bit different than what we've seen in prior recessions, and probably I give us a little more sense for optimism. So the next slide. So actually come back for talk about this, and then we'll come back to that one. So I think one more thing that's worth noting in that perfect storm is what's shown in this chart here. So every quarter, the Federal Reserve has its senior loan officer survey, and what they do is they poll banks, and they're asking them about what is within their institution since the last quarter, what's happened in terms of their lending standards for new CRE, among other asset classes, but new CRE loan originations, and what is the demand. So what you can see on the right-hand side with that sharp kind of uptick there is not only the fact that in the latest survey they just came out about a week ago, where they're saying 2/3 of banks who responded, they indicated not only that from a quarter prior, that they're tightening their lending standards. But if you look at that saying a quarter prior, but you look at the number like below that a quarter earlier, they were saying, well, we're still reporting, a good share of us are still reporting higher standards than we were a quarter ago. So it's, one thing to note that 67%, but it's also saying 67% over a quarter where there already have been tightening over a prior quarter. So this is kind of another big thing to focus on is what does this mean? And a lot of the conversation I've been having, and I was actually visiting with a couple of banks just recently and asking them what they're doing and kind of what is their outlook on what's going to be happening when these loans mature. And is there going to be more of a wait and see approach? Is there going to be willing to start to maybe get rid of losses, maybe sell at a little bit of discount in anticipation of potential impairment and future credit losses. So there's a lot of things to really contemplate and to kind of focus on, and we'll talk more about that in the rest of the session. But now getting to the one slide I was teasing a moment ago, which I think is a bit of a snapshot on the actual banking performance and condition.
Yeah, and before we get to that, I think it's important to note here as it relates to some correlation with regional banks stepping in, right? Is in 2015, I think regional banks took up about 15 to 20% of CRE lending. originations. And then right as COVID hit, they hit their stride and really started picking up. What you could see is correlated with the tightening around CRE lending for those CRE lending standards for those banks as well. They subsequently took a little bit of a step back and then really jumped up to that 30 to 40%. Chris, you and I mentioned earlier in terms of the amount of originations that they're doing in the space. So it's also interesting to see that the tightening doesn't necessarily correlate negatively. It more than likely correlates with the amount of loan originations that the regional banks are starting to make, since 2015, and that increased uptick and upward trend.
Excellent, thank you. All right, so here's a lot of numbers to look at. So I'm going to kind of guide your eyes to a couple places. So again, of those 4,700 banks, FDIC insured depository institutions, we basically that second column there says all institutions is the industry as a whole, and then using that same reported segmentation are in the subsequent columns. So there's a couple of reasons we wanted to put these statistics in front of you. First of all, what's actually shown in that little green dotted box is that larger community and regional bank space. So if you look at like the top two rows, which is reflecting profitability, the net interest margin at 3.6 and 3.3% respectively is among the highest within the banking industry. So a positive aspect of it is, by and large, community banks and regional banks are and have been benefiting from the rising rate environment because of the greater yield on earning assets. Now, obviously, there's downward pressure on profitability because one of the actual cost of funding, and then two, as we'll talk about in a moment, is the rapid provisions for potential future credit losses. But still, having said that, we're still seeing return on asset margins around 1.3% for that space. So again, pretty strong and pretty healthy. Jumping a little bit further down where you see that row where it says reserves to NCLs, that's basically reserves to a level of non-current loans or problem loans. And that 218% you see in that far left column, that is the highest that ratio has ever been in FDIC reported history. So what does that tell us? Well, if you compare that to where we were, I believe at the end of 2007 leading into the Great Recession, that number was less than 100%. I think it was like 70, 80%, indicating that for every dollar of bad loans, banks were setting aside like 70, 80 cents. So they were certainly under reserved, and then obviously that gave way to a lot of other things, including what we now know as CECL. But if you look at where we are today, the level of reserves to loans as an industry as a whole is about right around the long run average, about 1.6%. But I think it's pretty telling that you can say there's two things that come out of that reserve to non-current loans number. One is for every dollar of potential bad loans on the books, we're seeing more than $2 being held and set aside for reserves. So again, much more proactive when it comes to dealing with these problem loans than we were, at the last recession. The other thing it also indicates is it's probably a leading indicator of where things are likely to go. So in the conversations that I've had with a lot of banks, and I'm sure a lot of you guys have had these conversations internally yourselves, but think about it from the perspective of, we already know that rising rate environment, this whole perfect storm we're talking about, maturing loans, we're seeing those rising rates are causing upward pressure on cap rates, pushing down values. We're seeing a little bit more compression in rents and a wider gap between asking rents and effective rents. We're seeing vacancy rates, especially the office sector, coming up. So not only do you have rising rates, but you also have downward pressure on operating incomes, downward pressure on values. So if you think of kind of the primary drivers of default risk and loss severity risk when it comes to commercial real estate, DSCR values on average are going to be coming down. Loan to value ratios are going to be coming up, naturally going to be leading to more defaults. And then with depressed values, those defaults could end up leading to more losses. So from just kind of looking at the data and the conversations we've been having, it's certainly fair to assume that the very, very low level and nominal levels of credit risk that we've had in the past, largely that were protected by government action, I think we're going to likely start seeing a lot more of those problem loans coming up, even though if they're not necessarily manifesting so much on the books of banks today. You start to see a little bit of uptick in CMBS as a little bit of leading indicator. Another cause, though, for some optimism is if you look at those bottom three rows too. you can see compared to where we were in the prior recession, that the banks are very, very well capitalized. So, and again, what caused those three banks to fail earlier this year was not a capital issue, or was not a reserves issue. We talked about it was kind of a run on the deposits, having to sell low yielding long-term assets at a significant discount. So by and large, a lot of banks today, particularly regional banks, are in a much better position than they were to weather this perfect storm that's upcoming. So Ed, back to you.
Yeah, absolutely. And I think that as a good segue to that is really talking about the backdrop in which this regional banking crisis happened, right? At the beginning of 2022, we saw interest rates begin to spike at levels that haven't really been seen in 15 to 20 years. Further to that, we're seeing a low maturity bubble of really epic proportions coming up over the next 2 years. Some analysis estimates that of the approximately 5.6 trillion of outstanding commercial and multifamily mortgages, 25% is coming due in these next 2 years. So given that a large chunk of those loan maturities are in the office sector, I think we're going to, as Chris mentioned earlier, we're going to delve into that sector and really dissect how those loan maturities are further affected by the regional bank situation, as well as dive into some of the lease expirations that we see coming up. Chris, you put together this chart that I found really interesting as well in terms of interest rate hikes. So it'd be good, maybe if you could speak to this a little bit. I think it speaks for itself, but feel free to walk us through some of this as well.
Sure, thanks. Yeah, I think this tells a pretty nice story. So this little waterfall chart is looking at basically the last 10 Federal Reserve or the Federal Open Market Committee rate cycles. And so if we start from left to right, so if we look at 1999, 2000, during the dot-com boom, the Fed raised rates 6 times, so 6 hikes, totaling 175 basis points. That's kind of what you're seeing on that far left green bar, which got the target Fed funds rate to around 6.5%. Then following that boom led to the dot-com bust, and then we had 9/11 in 2001, which then there were subsequent 11 cuts for a total of 175 or 475 basis points, bringing down the federal funds rate to 1.75 or 175 basis points. And then you can kind of just see what's happening, and then it's okay, well, the recovery was pretty slow, so a year later, another 75 basis point drop. And then we had that help to fuel the housing market boom, which then a reaction to that was 17 hikes, getting the Fed funds rate back up to 5.25. And then that helped to kind of spur a little bit of the housing market crash, which then 2007, 2008, followed by the Great Recession, led to a total of 525 basis points and rate cuts, getting it down to about 0. So you can kind of see a little bit of a pattern and trend. So this is something like Economics 101, I'm sure everybody's familiar with. But what is really interesting is basically to combat in COVID-19, similar to what happened in the Great Recession, the rate cuts got basically the Fed funds rate down to 0. And then we saw a 10-year Treasury was down below 1%. Since then, we've had 10 rate hikes for a total of 500 basis points. So what that really jumps out at me is if you look at all these prior 9 cycles, even though you may have had more rate hikes, we haven't had any of them that have resulted in that sharp of an increase over such a short period of time. And that's really what's caused a lot of this kind of perfect storm combination, because we literally entered 2022 with a much lower interest rate environment, and then we're seeing how rapidly things have started to increase. So then if you start thinking about that, take a step back and say, let's now look at these commercial real estate loans that are maturing. When were they originated, and at what rate were they originated? And as they're coming due, especially ones that were originated with shorter maturities, those are coming due at a time when it could be really at the peak, which we're getting probably very close to, at the peak of the Fed's current tightening cycle. So now you have these maturing loans that are going to be maturing, refinancing, repricing at a rate that could be 200, 300, 400 basis points higher than what their current rate is now. And so that's, I think, a big point of concern of now, what is the ability of these borrowers, these properties, to be able to continue generating enough operating income to service that debt, to meet those debt service obligations, given that significant impact of what this very rapid rate increase is having.
Yeah, and I think that, just to look at a hypothetical situation here, especially problematic for those fixed rate loans, whereas you mentioned they may have come in at an interest rate around 4%. And now as we start to see this tightening cycle, getting up to, 300 to 400 basis points higher, even if we look at how that impacts, the cushion that some of these, landlords and borrowers have as it relates to DSCR, what we're seeing is, an increased amount of debt service, against potential NOI, right? And I think that what's really problematic here is that it only tells half the story, right? So in this particular slide, you can see, given this scenario with a $20 million loan, a 4% interest rate, you're looking at an annual debt service of right around 1.2 million per year. And then you push that forward into a higher interest rate environment that we're having now, and we're looking at 1.7, 1.9 million. And the issue with that is that you're going to start to see this higher default risk amongst a lot of these properties. This doesn't even capture NOI, which in this slide has remained static, right, at 2 million. But you can see how it just alone, that interest rate situation is affecting the debt service coverage ratio.
Great. And then I just go back one slide. And
Sure.
so this stylized chart on the right-hand side is an illustration of what we actually see empirically, which is there's a non-linear relationship between a level of debt service coverage and default likelihood or default rates. So at a reasonably healthy 1.6 times debt service coverage that you're seeing in scenario A, you might say that's going to be somewhere on that left side of that horizontal or x-axis. And on the right-hand side. And as the rate, all else being equal, as Ed was saying, as you start moving further left down, on that axis, you start to see exponentially the level of default risk start to come up. And so then if you start now extrapolating that across a portfolio of properties, you can start to see kind of the contagion or how these things could all move together. And then you start thinking of, well, how much exposure do I have to a particular sector that's struggling a little bit, or how much exposure do I have to a certain market or sub-market? Because if you're starting to see that type of behavior and activity, then not only do you have kind of the effect of the rising rate on the increased debt service, but now you're looking at the fundamentals that are happening in that particular market for that sector. And as we were talking about earlier, the downward pressure that might be on rents, upward pressure on vacancy rates. So in a realistic scenario, it's likely to expect that NOI, in most cases in this environment, is going to be coming down at the same time where the debt service obligations are coming up. So then if you think about what does that then do, so you have the elevated default risk, and then if you think of what also influences default risk is the amount of leverage. So all else being equal, if you have property cash flowing at 1.1 time, but they're looking at a 40% LTV, the likelihood of them defaulting is considerably lower than the same debt service coverage if that loan to value ratio climbs up to 90, 100%. So not only do you have kind of the effect of the rising interest rate, the downward pressure of what's going on influencing default risk, but you also then have the risk of that added leverage is kind of another trigger that also will influence, should default happen and should foreclosure take place, would also then result in a much greater loss severity. And if we kind of tie that back to the regional banking crisis, that's an area where it could be a factor, because there's an estimated, I don't remember exactly where I read the article, but I think there is an estimated some economist study that said that if you look at the level of securities and loans, the market to book value difference is about 2.2 trillion, meaning that the market value is lower in this environment. So if you start to kind of think of that in the context of, well, maybe these loans that we have on the books in certain sectors, certain markets, if they're not faring as well, then you could have some impairment. And as you have impairment, you start to write those down and you start to see those charge-offs or put those on non-accrual. Then that confidence crisis could come into play. And now you start to see a little bit of concern and then some of that potential contagion effect. I don't think it's anywhere near as bad as kind of maybe the headlines are making it, but it's certainly something that is noteworthy and what I would definitely recommend being mindful and aware of, because that is a realistic situation given the economic situation, the interest rate situation, and the maturing loans that we're talking about. All right, back to you, Ed.
Yeah, and again, these above assumptions were made with zero loss to NOI, right? But now with pending lease expirations, DSCR is set to drop even further, making refinance near impossible and default likely. And so let's take a look at some of these tables here. And this was actually drawn from a report that we had done with TREP not too long ago. But as it relates to the office sector, one particular losing asset class since the onset of COVID, it's particularly troublesome. For one, quite a few office property loans are coming due over the next year and a half, many of which are regional bank loans. This is compounded by the fact that at least one of the top 5 largest tenants at these properties has a lease expiration within the next 2 years, coinciding with those loan maturities. So this equates to about a total of 20% of the building square footage on average. Parking that latter point, we could, again, getting back into loan maturities, it's important to understand that DSCR is already set to be in a bit of trouble. If you add into that some additional points here regarding lease terms, right? So not only are lease expirations coming due, lease renewals, a lot of these are shrinking. Ever since COVID, a lot of these, the lease terms have been shortening and shrinking in size and amount. The average office lease term is down nearly 12% from 2019, and the average office renewal transaction size is down nearly 29% since pre-pandemic levels. This has been trending downward since 2019, indicating that tenants opting to stay in place may be selecting smaller footprints with a bunch of concessions, right? And I think that's another thing to be wary of is a lot of these leases that are being either renewed or new leases that are coming up, which we've actually seen somewhat on par with pre-COVID levels, are what you're not seeing is a lot of this free rent concession, a lot of the TI concession that's coming on board with these. So what's the good in all this, right? Is there any silver lining here? And as much as we could say good, there are some silver linings to all this. For one, since this data was compiled, I think at the end of 2022, we've seen quite a bit of these larger tenants start to renew their leases, right? So that's going to obviously not impact NOI as drastically. Secondly, there's anecdotal evidence that the companies are moving away from a full remote into a hybrid or in-office policy, even across larger coastal metros. Thirdly, we're starting to see an uptick in distressed office sales. There was actually an article released recently from the Wall Street Journal, as well as one from The Real Deal. This is good because it's starting to show some movement in perhaps this most affected asset class. The volume of distressed office deals is likely to increase over the coming months as these loans reach maturity and owners are left with little recourse other than to sell. According to that Wall Street article, Hines bought, I believe, a distressed office tower in DC for less than half of the cost to develop. By paying that price, Hines is able to invest enough in interior work and amenities to sign, and they have signed Davis Polk, I believe, a major law firm, which will occupy more than half of the ability of the building's available space. So why is this good, and what does that mean? Well, as it relates to the regional bank crisis, it means that there are still lenders out there making loans, right? Even in a distressed asset class like office. It means that even in the most beleaguered asset class, lenders are still willing to get in and make loans to that property sector. The void left by some of these regional banks as those standards start to tighten can potentially be filled and start to be filled in part by credit funds keen to capitalize on these high interest rates using floating rate loans, and also to mitigate the impact of a lot of that DSCR. We're looking to see loan structures include interest rate protection, which is paid for by the borrower, effectively creating minimums to DSCR. This is evidenced and drawn from a white paper recently put out by a credit fund. I believe it was actually yesterday. And then lastly, and I'll dovetail this into Chris's next topic, as we saw during the GFC, there is a likely scenario where lenders extend the term of the loans until the market is in a better position for borrowers to refinance. So with that, I'll hand it over to Chris to talk about winners and losers in the CRE space.
Great, thank you. And I know we've got roughly around 20 minutes or so left, and it would be very easy to spend quite an extensive amount of time if we're really to try to break down the core four and then other specialty sectors and then markets within those sectors and sub-markets within those markets. So what we want to do is at least give a little bit of highlights, really kind of capturing more national trends and some more market information, kind of talking about a little bit of what we're seeing in the converse, what we're seeing one in the data, and then also what we're hearing in terms of the conversations that we're having. And it's key to take away that it's very nuanced. So if we're starting to look at, I'm based in the Austin area, and it's like most of you can appreciate, if you go look at, if I look at what happened to multifamily in Austin, there's been a ridiculous amount of new construction and new inventory coming online, and that's actually start creating downward pressure on rents, and it's starting to really slow down what during the pandemic was one of the hottest residential markets. But then if you start now, all right, well, where in Austin? You start looking down at the downtown Austin or certain suburbs, it starts to vary quite a bit. So I just want to at least caveat what we're going to be talking about with some of those nuances and kind of just give a little bit of highlights. And our contact information is going to be available after this. So if people have questions that we're not able to get to, I think we're going to have another session on this. Happy to entertain those and engage with those. I really enjoy having these kind of conversations because this is kind of what we learn from looking at data and what we learn from having discussions. But with many of you kind of boots on the ground and your perspective, it's always good to hear what's actually happening in practice outside of what we're seeing. So with that, let's jump to the next slide. So one of the things that's really interesting, and we talked about at the outset, is commercial real estate loan concentrations. And as we were talking about earlier, if you look at the segment of the banking industry that has the greatest amount of CRE loan concentration, it's by far community banks and regional banks. And so that is why that's relevant to this kind of perfect storm and what we're talking about now is because that somewhat puts a cap on the capacity or the amount of additional commercial real estate loans that a regional bank can make. Because if you're looking at what percentage of their total loan portfolio is concentrated in commercial real estate, or what percentage of their total capital is concentrated in commercial real estate. So this visual you have here, we basically took the top 10 US economies by state GDP, and then within there took the median ratio of commercial real estate loans outstanding at the end of 2022 divided by the bank's tier 1 capital plus reserves, so their cushion. And so if you look at the color coding, the brighter the red, the darker the red, that's higher concentration, higher risk, so to speak. More the green, that's going to be a lower. So on the left-hand side, looking at California, of the 131 banks who are based out of California, they hold a total of 1.2 trillion in assets, but have a staggering median CRE concentration rate. So again, CRE loans to total tier 1 capital reserves of 354%. So obviously that's a median midpoint. There's going to be some above, some below. It's pretty alarming to think there's going to be some above. But the reason that I think it's relevant is if you start saying, well, what's going to happen? One of the questions I think you have to answer that question with is, well, let's look at where are those properties located and who's actually financing those properties and who's likely to finance those properties. Because as we talked about, regional banks, community banks tend to lend more locally, whereas larger national banks will tend to have more of a national, broader footprint. So if you're looking at it from that perspective, the lending standards that are being tightened that we were talking about now become a bigger issue when you have a greater concentration. So banks that have higher CRE concentrations naturally are going to end up being a little more conservative with the type of new business they bring on. And in some of the conversations I've had just recently over the last few weeks with some banks, it's exactly that. It's like, we're going to be a lot more selective and more prudent in the type of new business we take on, especially because we recognize that there's a good likelihood that we're going to end up having to probably renew or extend some of these existing loans that are in our portfolio and kind of, work with them as we kind of get through this part of the cycle. So I'm not going to read all this to you. You can kind of get a sense for what the colors are, but then you look at Texas, for instance, 387 banks based out of Texas, similar total assets. So you could see certainly much more concentration in community and smaller regional banks. But that level of CRE concentration median is only 200%. Then you look at Ohio, 141%, Florida pretty high at 265. So again, kind of the big takeaway here is recognizing that the ability for these regional banks, who are typically going to be a source of capital for new commercial real estate loans and for new refinancing, one of the constraints they're going to have to work with is the level of concentration that they actually have. And we have another table coming up on the next slide, kind of giving a little more into that.
Yeah, and I think that what's important to note here as well is, as it ties back to the growth or the increase in regional banks and CRE lending since 2019 is, I think that it's been widely thought that the growth in their market share has been viewed as smaller lenders stepping up and taking on risks where other banks wouldn't. And to your point, and even just looking at this map, there's definitely more at play here, right? Smaller banks tend to lend on smaller assets and smaller markets, and as COVID came along and savage deal volume in the expensive coastal markets, right? You see Florida, you see Jersey, you see California in red. Investment activity shifted away to smaller locales dominated by these regional lenders, right? So I think it's important to even tie that back to the growth in regional banks since 2019, since roughly 15 to 20% up into the 30 to 40%, nearly doubling.
Excellent. So this chart basically is a further illustration or breakdown of what we were talking about. So the blue bars represent that ratio, median ratio we saw on the US map, and the orange bars represent CRE as a percentage of total loans. So if you look at the largest banks in the far right, you can see that a little more than 10% of their total outstanding loan portfolio is concentrated in commercial real estate, and about half in terms of 50%, 55% in terms of percentage tier one core capital. Then if you go and look at that at the regional bank side, so kind of working towards the left, then you're looking at about more than a quarter or half of the loan portfolio is concentrated in commercial real estate. Again, kind of the same theme we've been saying throughout this session. And then a pretty eye-opening level of concentration when it comes to capital. So you could see the larger community, smaller regional bank at over 300% of total capital, nearly 200% for the mid-size and larger regional banks. So again, that's kind of just re-emphasizing what we're looking at on that map as a geographic perspective, but now kind of breaking it down a little more within the actual banking industry by size. Okay. So the next couple of slides that we have, and looking at the time here, we've got like about 10, 15 more minutes, really just are some highlights on what we're seeing within just more in the broad sectors. So again, it's very nuanced when you start looking at it, breaking it down by individual markets, things like that. But generally speaking, I think one common theme that most of you are well aware of, we would talk about now, is if you were to just rank order probably the risk in this perfect storm as far as just sectors go, independent of markets, you'd probably say that office is number one. There's a little bit of an interesting twist with like retail because of such strong consumer demand. Retail has actually done reasonably well, save for malls and big boxes. And then looking at multifamily is really strong source for a long time. And I'll kind of talk about each in a moment, but I just want to give you at least kind of high level punchline before we go. Okay. So in multifamily, again, has historically been very low risk, certainly low risk in terms of a credit risk perspective. And, it has been low risk because of population shifts, population growth, especially like in the Sun Belt area. But again, we're starting to even see a little bit of flipping there because of just the rapid oversupply. So there's another theme there. And then because of the rising rate environment, how long it takes warehouses and distribution centers to get built, you're starting to even see what has been kind of a darling over the last few years in the industrial sector, starting to see a little bit of cracks. So again, those are just some very quick highlights for if we don't get through all of this stuff, because it has changed a little bit. Because if you were to just ask me, what has it been? I would say, well, number one is office risky, then it's retail, and then it's probably industrial, much further down, industrial and multifamily. And why that rank ordering probably still applies, I don't think the narrative around each is the same anymore. But certainly the more glass half empty perspective is on the office sector for a variety of what we were talking about. Some interesting statistics are that companies and office using organizations are now using less space or less square foot per employee than any time in recorded history. So that's so you look at vacancy rates, but you also then look at physical occupancy rates. So when I was spending time in New York, physical occupancy rates were considerably less than what I would see when I recently went into an office into a bank here in Texas. So you're definitely seeing the demand for actual space being much less. So therefore, the actual space per employee is at that record low. So that's a really important statistic, which again, does vary within buildings, does vary within markets, sub-markets, but nonetheless, the fact that statistic exists, I think is a very telling story. Another one is the total amount of net absorption. So I've just got some notes here, just to make sure I got my numbers right. But the total amount of net absorption or space being given back since 2019 is somewhere around 140 million square feet. So reference, that's about the size of Pittsburgh's entire office inventory. So if you just think of what's actually happening as far as space being given back, and you start thinking of that as far as what the actual need is in the square foot per employee, again, that's another pretty interesting statistic. And something that doesn't necessarily show up in vacancy rates is really the availability rates, because what we're seeing, especially in markets like San Francisco, is the amount of space that's being subleased. So you might have a national average of around 13-14%, depending upon your source, of a vacancy rate, but you're probably closer to 16, 18, maybe 20% if you're looking at in terms of availability. So why is that relevant? Why is that important? Because as those leases come due, and now that space that's being subleased is very likely to be given back. So not only do you have the higher vacancy, but that availability rate and that sublease is probably more indicative of what you might be expecting for that property's ongoing NOI. So if you start thinking of what we were talking about in terms of debt service coverage abilities, you have to factor in take into consideration the fact that a lot of this space that's even being sublet is likely to then be kind of given back, and that's going to be more space given back over the course of the next year. And then in terms of transaction volumes, again, we start looking at that as a reference point of, hey, are we seeing movements in values, or what are we seeing in cap rates? Well, there's a little bit of bias there too, because only the best properties with strongest fundamentals are the ones that are really transacting right now. So while you can certainly look at cap rates and say, hey, they're not coming up as rapidly as I thought they would, and we're seeing more stability in values, again, you got to take that in consideration, that the sample size in which those numbers are based upon are limited to those properties that are probably Class A properties with stronger fundamentals in desirable locations. So over time, we start to see, as I think Ed was talking about earlier, you start to see some of these distressed sales, you start to see more of this activity, then you get a wider sample size of what are we seeing in terms of older vintages or different classes or different locations. So that's kind of the glass half empty, but we don't want to leave it on that. So if we go to the next slide, there are some things to be optimistic about. As we mentioned a moment ago, like the market has become highly fragmented. So properties, for one, Class A properties that have been built more recently still have very high demand, even though the actual demand for space is less. The demand for those properties are positive, and you see that positive that absorption. And if we think about in this market where we're trying to get people to come back to the office, I think there's a recent article in the journal that said something to the effect of 42% of companies are requiring their employees to come back on a full-time basis. And if we're starting to go into recession, that might be a little bit of leverage for employers. So one of the ways to potentially attract and retain talent is to have them coming into a modern building that has a lot more amenities, more natural lighting. So that's kind of helping to kind of keep those more desirable modern Class A properties a little more afloat than what you might see in some of the other segments. In terms of markets, like Dallas and Atlanta is a couple of examples. Texas markets, I've seen just from my own experience, the physical occupancy in office buildings is much higher than other places, definitely like the Northeast and the West Coast. So you have that, which is also being reflected in actual positive rent growth, whereas much of the nation are seeing flat or even negative rent growth. Atlanta, similar story, another top 10 office metro, has had about 1 million square feet of positive net absorption over the last 12 months. And as a result, we talked about sales volume being down, and I think being down year over year, somewhere to the tune of like 80% nationally, but it's about half that for those markets because of those factors. And then because also those cities are also enjoying lower unemployment rates and positive population, increasing population growth. So unsurprisingly, those are kind of correlated with the performance of those markets. And then another positive aspect of it is if you look at the projected inventory square footage coming online in some of the major metropolitan areas, it's over 25 through 27 is expected to be considerably less than what it's been in years leading up to the pandemic. So that hopefully will help with some of the supply issues, help with vacancy, and help to maybe accelerate some rent growth again. So a big question, which I don't have the answer to, but just through some conversations, is what are people going to do? So if we're anticipating, you kind of look at that chart about the rate hikes and the Fed's activity, if we're anticipating that there's a likelihood that we're either in or going into a recession, and that maybe we've already kind of hit the peak or very close to hitting the peak of the rate hikes, then is there going to be more of an interest in trying to exit these loans and to maybe take some losses, or to actually ride out the storm, which seems to be anecdotally from some of the conversations I have, where a lot of people are leaning toward and working with their borrowers. So you could be looking at this really as a cyclical thing where it's not necessarily as dire as, because we kind of see a light at the end of the tunnel that might potentially be happening in 2024 after 2024. So I'll just pause there, Ed, for a minute, because I know we've got about 5 minutes left, and there's certainly enough we could talk about with the other 3 of the core 4 sectors and others. But I just want to kind of touch base on a little quick time check. I think we're going to share this slides with people. So if we're not able to get to everything, then at least at a minimum, we shared some of the highlights before we jumped into the office sector. But happy to certainly answer questions after this and extend these conversations.
Yeah, and I believe, and I forgot to say this at the outset, that we will be hosting another Q&A session to address some of the questions that have come across. So we will be holding questions for this session, but we will, however, likely have a second session in the next few weeks where we'll address some of the major concerns and questions that have come across throughout the presentation. Chris, we still have a little bit of time. We can, roughly touch on retail and industrial and apartments. I think that you could already think about who the darlings of the CRE space are right now in industrial and multifamily. Although I think you had some key points specifically as it relates to multifamily and even retail, which has been kind of mired by problems with e-commerce and on the flip side is what's led to a lot of the uptick in industrial. But in terms of retail, what is there to be optimistic about here?
I think the first bullet point you could see there, the retail space market is at its highest level on record, so less than 5% available. And if you think of just the U.S. economy, it's part of the reason why we're having this rising rate environment is because of the rampant inflation, which has been driven by consumer spending, which has been to the benefit of the retail sectors. Now, sure, you have the larger like Neiman Marcus, Bed Bath and Beyond, big box stores, older malls that are not faring well. But if you look at like, smaller ground floor retail and mixed use buildings, if you look at areas that are growing and suburbs that are growing, and you see a lot of these like, store like smaller like strip malls. I think Starbucks has been a big source of a lot of growth in some of these areas where you're seeing population shifts. So it's compared to what the conversation was about retail 6 months ago, a year ago, I think it's a little bit more optimistic. And another key thing is if you think of, which is like this third and four bullets down, which is what's actually coming online now. So both developers and banks, being a little more risk averse, are staying away from speculative projects. So pretty much like 80% of all new activity or new development that's coming online is already with tenant in place delivery. So one, that's less risk from a bank perspective. But two, now you don't have a lot of, you're basically now keeping up with that, kind of keeping the supply low. So it helps to kind of keep rent growth a little more accelerated, and also to keep vacancy rates, that availability, relatively low. And along those lines, a lot of that new construction is really for like single tenant built to suits or smaller, as I was saying, the ground floor places, ground floor spaces. But then if you just look at it in terms of, on where that's happening. So again, strong correlation with growth in buying power and population. So if you start thinking of in the Sun Belt, the South, the Southwest, I know being in Texas, we're seeing absolutely a lot of that in the new construction. But again, that's all kind of, that's new construction that's already being kind of pre-leased. And then you're seeing in markets that have older inventory, those are starting to come down and getting repurposed. So it's also the flip side. We could kind of jump ahead a little bit to the multifamily, which is whereas you're looking at from a retail perspective that the Sun Belt area has actually been doing very well. Multifamily previously had been very red hot in those markets, and again, being where I'm at, located in Texas, you are starting to see quite a bit of a pullback and slowdown. So some of the markets that are actually faring more favorably now are like in the Northeast. And I know in conversations and some of the research, like up in New Jersey, in areas, we're starting to see a lot more of an uptick because you didn't have that supply demand imbalance that basically has been happening over the last year or two in the Sun Belt area. So I think now it's interesting because I think the conversation is a little bit shifting, where retail was similar in that same conversation as being beleaguered with office, but seeing that there are actually some positive signs there. And there's also some potential red flags in those otherwise very hot and desirable markets in multifamily. And I guess the last thing I'll say on the industrial front is because of retailers and wholesalers, they're big investments. These are very long projects. So they're being a lot more risk averse. So expansion ideas, acquiring new space, that's already slowing down quite a bit. So I think while the industrial sector still is a low risk from like a credit risk perspective, because of that slowing, then I think you're already starting to see a little bit of cracks there. The good news is because these projects take so long to get completed, and these, over a year on average for some of these larger buildings, that the fact that there are people being more on the sidelines, that's actually going to hopefully help to kind of address some of these challenges that we're facing now. And then at the very bottom, you can see with alternative uses. So you can see like there was the Inflation Reduction Act, the CHIPS and Science Act, that basically saying like nearly $500 billion in incentives for manufacturing of high tech in the US. Again, being in Austin, like the Gigafactory with Tesla and the electric vehicle plant openings. So you're starting to see more specialized uses where those are actually faring a little more favorably, and that's kind of showing up in those headlines. So again, I know we're just about out of time, so I'll pause there. And like I said, we can certainly entertain questions at a later date on this stuff because we could go on for hours, but at least wanted to touch on kind of the highlights for each of the core four.
Thanks for that, Chris. And I think that, now that we've kind of gone through not only specifically what's going on with regional banks internally, we've touched on kind of the broader environment that this regional bank crisis had occurred in, right, with loan maturities and lease expirations, and really touched on a lot of the sectors that we see as potentially winning and losing out of this, all things involved. What can we say are some good actionable insights going forward, right? We've explained some of the trends. How do investors, lenders out there, how can they be more prepared? How do they stress test going forward?
Sure. Oh, I think one thing, just, kind of one-on-one here again, is like real estate is very localized. So when I'm making broad-based comments about the office sector or even multifamily in Austin, it's very nuanced. So you have to look at it from that perspective. So almost one way to take it is, let's start at almost like a 30,000 foot view. And then you're like, okay, well, what do I need to be aware of? What exposure do I have? So what do I have in terms of exposure to different sectors, different markets, sub-markets? Then within there, what do I have that's potentially coming due in the next 12 to 24 months? And within those that are coming due, or those leases that are expiring, of the maybe top 5 tenants, how much square footage is actually coming due? So it's really starting, I think, at a kind of a higher level of looking at what the exposure is, and then looking at kind of those elements of the perfect storm, which is, okay, well, if you've got leases coming due, how much space are they going to want? Are they going to stay in place, and how much space are they going to want? Or if we look at it in terms of loans coming due, it's like when it was underwritten, what are the terms at which it was underwritten? What is the rate it was underwritten? So I think if you just start looking at it at the kind of a high level, and then be able to kind of focus on each of those elements, that's a really good way to, I think, prepare and then you can kind of drill down individual properties from there and individual markets and submarkets.
Yeah, agreed. And I think that what's going to start, as I mentioned before, what we'll start to see happen is a lot of these B and C class buildings will likely be sold at a discount, right? However, any additional capital that's saved from the purchase of that property will likely be used to increase amenities and make those more attractive to tenants, right? One of the charts that we showed earlier is showing how new renewals are essentially right on par where they were pre-pandemic levels. And so renewals is where we could see some issues. But as you mentioned, if you can lock up that tenant for a longer period of time, alternatively, I know, and I peeked into the Q&A section, there was a question about regional banks extending those loans. I think that that's a really real possibility. I know, Chris, you mentioned to me earlier that you had a conversation with a bank recently, and that was something that came up in that conversation. And then also is, there's no coincidence that one of these private equity funds released a white paper around CRE lending and how they're going to be able to produce better risk-adjusted returns, right? So, there's $2 trillion of regional loans out there. Will credit funds be able to fill that gap entirely? Absolutely not. Will we see them continue to grow as they have since 2015 when regulations tightened around banks? I think so, right? Especially as they are able to capture a lot of those loan maturities that are coming due, and be able to capture a lot of that return that banks, given tightening, won't be able to do.
Exactly.
As Chris mentioned before, we're going to be having a lot of questions from this. We will be doing a follow-up webinar with a live Q&A session where we'll happily answer a lot of those questions. Keep an eye out for an email with details about our upcoming interactive Q&A session, and gives a chance to be able to compile some data about those questions ahead of time. Lastly, you can obviously find more information about CompStak on our website, CompStak.com, on LinkedIn, Facebook, Twitter, and CompStak, our Instagram page. Chris as well obviously has his LinkedIn page, Henkel Analytics. And so feel free to reach out to us with any questions that you may have on a one-on-one basis. Chris, Chris, anything you wanted to wrap up with as well?
No, I just say I really appreciate. We had a really good turnout. I've seen a ton of questions coming in, so I just want to thank the audience for spending the time with us this afternoon and dialing in. And I think it's a really exciting topic, and I enjoy spending a lot of time researching it and having conversations. And look forward to hearing from a lot of people who attended today to kind of get their perspective on today's session, but also their perspective on what's going on in real estate and regional banking.
And again, from us at CompStak and from Henkel Analytics, thank you again for joining us. And we look forward to the next session.